Hi, Adam.
Hello, Dale.
Hey, welcome back, partner. How are you?
I'm doing pretty good. It's summer's zipping by, but life's good. How are you?
I'm doing fine, Adam. Want to congratulate you on your analysis last month. You stayed negative the euro based on the seasonals, and we have continued follow through to the downside, challenging Friday's lows here. Everything's still in gear, or did the seasonal shift into August?
Yeah. Well, thanks a lot, Dale. I mean, we talked about the euro last time. We talked a bit about CAD yen. Had a nice pop. Came off a little bit after that. Things are in line. I mean, we see it with the fundamentals too, and we talked a lot about that. How it was just getting better in the U.S. We just had this ISM number pop out, services, and it was strong again. Good revisions of durable goods and factory orders. The picture toward and the market has really gripped this theme now of the Fed's moving towards tightening, even though it's a very, very slow process. It's helping the dollar, and that's really the story today. So for seasonals, for now, we can take a look at some of the charts if you'd like, and talk about what's hot in August.
The dog days of summer. What are you looking for this August?
Yeah. I mean, it's nice to see some volatility today. It was awfully dull yesterday.
Anything special from the ECB this week, Adam?
Yeah, I don't think there's a lot to expect from the ECB. It's not. It's a bit of a wait and see sort of moment for the ECB right now. So we'll see what happens there. But Draghi's a very clever guy, and he's been good in the past at finding ways to hurt the euro, and certainly the wind is at his back at the moment with the euro just getting beat up, and even as we speak, really, I think we just took out that last week's low down to November lows, so tough times for the euro.
Yeah, definitely. Everyone keeps waiting for a retracement to sell. There were a lot of people that had their orders ready to get short if we had a rally back to 520. That's not happening, at least for now. Does it bother you at all, the unanimity of bearish opinions in the euro out there, Adam? I mean, everyone knows where they want to sell it if it rallies, but you don't hear anyone, not even a lone wolf, talking about where they would buy the euro.
Yeah, I know it is. It is a little disconcerting, and you see some of these. Same thing in cable. It's fallen so many days in a row that you can't chase. This is like the first rule of trading. So, you want to see a bounce. Everyone, yesterday talked, well, let's get a bounce up to 135 or 134.80 or something like that, and then we'll sell the euro there. And then, you turn around today and you missed it again, down 56 pips. So a lot of these trades, maybe you can wade in so you don't feel like you're missing, and then you don't make a bad decision. And then hope or just reload if it bounces. But it's a tough trade. There will be the bounce ultimately. But I agree with you that it is a little bit one-sided.
Yeah, completely. Here we are making new lows. Everyone's right. So I guess that happens once in a while. So seasonally, we're looking at U.S. dollar yen, and it doesn't look like anything dramatic, but a down month in August.
Yeah, so you see July, it would have been a tough month, but the seasonals didn't really work out in July. I mean, at the start of it, we did see a bit of weakness in dollar yen, but the strength late in the month. But I've really just highlighted, you can see August sort of in the middle there of this period, this July to I guess that's the end of October period. It's the weakest time of the year, collectively for dollar yen. Okay. That's tough to reconcile right now with what we're seeing in the market. It has been a strong dollar, even just the latest tick. I mean, we have dollar yen ripping higher here again. And you have a few things though at the same time. I mean, Japan is rolling out some weak data. We're going to get GDP next week. Might be a 7% annualized contraction in GDP in Q2 there.
-7.
-7 is the talk right now. They had the tax came in, but that's brutal by any stretch. And then you have pressure on the BOJ to do more, which should boost dollar yen up further, and the Fed, going with it as well. So, the fundamentals don't mesh so nicely with the seasonals there, unless the unexpected starts to happen. You have the Bank of Japan saying, well, we're not going to do anymore. And you have, more risk aversion in markets. You have bond yields, continuing to drop. So there, that you can make a case for weakness. But I think that the kicker would be Jackson Hole, which is the 21st of August, is sort of quickly becoming the next big thing to watch. What the Fed will say
We've seen
there,
some inflection points around the Jackson Hole in the past, haven't we?
Yeah, you know, it would year after year, and that was QE. I think it was QE2. It was rolled out there, and you know that's way back in 2011, and then 2012. You had some announcements as well. And then, you know, last year Bernanke skipped it, so he snubbed the sort of conference. But Yellen's there this year, and it's a good time for her to be hawkish. I'm sure the market will price in hawkish comments. They do it every single time. So, you know, but last time, you know, we saw the Fed statement. It wasn't as hawkish as people were worried about. And the dollar really didn't get beat up like you thought it might be. I mean, the market just wants a little right now, and it's willing to buy the dollar. So it's really tough to bet against the dollar. That's what the seasonals are saying, though. So, you know, it could really come from the risk aversion side. I mean, so many people, I think, were waiting for the S&P 500 to hit 2,000. And, you know, we're buying these dips and buying these dips. And again, you know, some pain in the stock market again today. Well, you know,
that's a change of tone from you from the last year and a half. Kudos to you. You stayed positive risk assets, S&Ps over the last year. Every time you saw something seasonal, you talked about, you know, things are good, the economy's coming back. You were right. Am I noticing a change in tone in you as far as S&Ps and stock indexes?
Yeah, I mean, we could skip down to the seasonals there on stocks as well. They're not great for August, and you know it's harder to get a good reason to buy stocks right now. I mean, we'll see. I mean, ultimately,
this is a shift for
I'm
you,
still
though,
a little bit constructive, but you would have thought we would have got to 2,000. But yeah, you know, I hate to draw conclusions in August about price action. It was strange the way the markets acted. And if we continue to see this volatility, I think, you know, it's time to be a little more cautious. And you're right. I am a little bit more cautious, but ultimately, this has been a very strong bull market, and it's probably going to continue.
Well, you know, August,
at least until we really hike.
Well, August, you know, having been in the markets for generations, I go back to August 1982, and that was the launch of the bull market from under Dow 1000. I think we were 780. And then you jump to 1987, and before the October crash, August was the high. So, you know, a lot of people not looking for anything major in August. Maybe something major in August does happen.
In the crisis as well, it was the month where things really started to crack. I guess it would have been 2006 or 7. The bond market started to really, and it's one of those months where if you're really paying attention when everyone else is at the beach, I think you can get an edge. You know, and I think that could be what's happening right now. You're going to see a lot of dip buying in stocks, and maybe, you know, the smart money is starting to get out. But same as bonds. I mean, yeah, it's tough to call a turn in bonds because everyone has been wrong so many times, and we'll get to that. But let's folks, we'll do a quick run through on the seasonals. I don't want to dwell because there's not a lot of great. There's a couple really good ones we'll get to. Looking at oil. And oil's such an interesting trade at this time of year because of the hurricane storm season. There's one out in the Atlantic now. And, you know, the conventional thinking is that it's a good month for oil because you always seem to get a spike somewhere here in this August to October period with a hurricane. But if you look at the average, you know, the long-term average, it's a very weak period as well. In August, and then into September is very weak. And I think even in more recent years, it starts earlier. I think in the past, you've seen this premium built into oil about storms, and people just worried about it, so they stay, you know, they stay long oil. But now you're getting a few changes, even just in the last 10 years. You have better data, you know, better access to data, the National Hurricane Center. And number two, you have more U.S. imports from elsewhere, less from the Gulf, more from Canada, more from, you know, Venezuela. I mean, a lot of those ports still closed, but I think the market is a little bit more relaxed now about supply, and that, you know, you have still a lot of dumb money coming in and trying to stay long oil, and it's proven to be a tough time to stay long oil. So I think the trade is if you get a spike, you just get a $3-4 rally on some storm news, maybe sell it in the next month or two.
Okay, so looking to sell strength in oil this month if we get a bear market rally. And to you, it looks like the top was in WTI up there around 106 or so.
Yeah, 110 and 106,
Yeah.
107. We couldn't get up, and then we kicked down, and we had this wicked. About 2 weeks ago, bounced back up to 104 from 108, and then just smashed right back down here at 98 again. Sorry, not 108, 98. Stocks, we talk. It's a bit of a weak month. You see the long-term average. It's about the third weakest month in stocks. The last few years, a bit soft as well. So, I wouldn't say there's a big trend there, but it is a softer month in the stock market. So maybe a good time to start to see a little bit of negative sentiment coming into the market. I think the market is deathly scared of Yellen coming out and saying something hawkish.
Okay.
So, market running scared a little bit, and, it's clear from the last 4 days. But, you don't want to draw a conclusion on the last 4 days. We could just as easily turn around today and end up 15, 20 points just the way the market is.
It looks like the new line in the sand for bears to defend would be up around 1950 in the S&Ps.
Yeah, I think you're probably right. If we get up above 1950, we'll do another push towards 2000 again.
Okay, so we've covered crude, S&Ps, U.S. dollar yen.
Just the dollar yen, yeah, bonds. Quick one on bonds. This is yield, sorry. So inverted bonds, but it's the worst month for yield. So best month for bonds is August, and you can't. That's in the long-term average in the last 10 years as well.
So this is yields continuing lower as a seasonal tendency.
Exactly. And it's been such a brutal trade for bond bears. We joke about it all the time because if you want to be short bonds, kiss your wife before you go to work, tell her you love her because you're going to come home poor. Because so many people have tried to short bonds for so long.
Will she kiss you when you come home?
Yeah, you better.
Good one, Adam.
Because if you can't have money, you better have love. And yields. There's a lot of talk now about getting down to 215, 220. Just because the Fed goes to 1% doesn't mean that if the Fed raises 75 basis points, 10s don't need to go up. You have Canada, 220 in Canada, and the central bank rates it at 1% there. And I think, there's a lot of reasons for the Fed to hike, and I'm not sure inflation is one. We can talk about that more. But bonds and that's a negative story for dollar yen as well. So that kind of feeds back into that. But that's, I think, really the place to watch. There's a real battle lately in the bond market.
I use TLT as a proxy, Adam, and I was looking at weeklies over the weekend. That's what I do. I'm obsessed with the markets.
TLT is the short ETF, right?
20-year Treasury used to be Lehman's, now it's Barclays, and to me it looked like we're almost getting close to a 61.8 retrace of the bond break last year. So to me it looks like 117 TLTs, that perhaps there is one more leg to the upside in bonds and down in the yields, and might be an attractive sell then. Perhaps all the husbands that have kissed their wives will be
once they're all cleared out
by then, and then it'll be a good trade.
Once everybody's quit, once the last bond bears have given up, then that'll be it. So it's tough to really buy bonds here at 250 or in the long term 330. It's just not much yield. So
anything you're focused on in commodity currencies or?
Yeah, it was perfect. Perfect timing, Dale. It's like we planned this ahead of time. Aussie dollar. This is really one strong seasonal trend right now, and August is easily the worst month. Well, not quite easily, but definitely the worst month for the Australian dollar. Kiwi dollar, similar story, and we'll pull up the charts in a little bit as well. We had the RBA overnight. They were a little bit more worried about inflation, and now here we are, Aussie down a quarter cent anyway. And, there's just no scope for a rate hike. And there is always that outside possibility of a rate cut if we start to get bigger problems. So it's a good time seasonally to be short Aussie. I'm not sure that, the timing is perfect, but, around that 93.40, 93.20, we're pretty close, pretty good levels. I think we had a breakdown So this is the weakest month for Aussie dollar. I looked at euro as well. I didn't put the charts in. It's about the fourth weakest month for the euro. But you're selling into a lot of weakness if you're selling the euro now.
Hard to do.
So yeah, it's just hard mentally, and it's hard as well. So there's the Aussie chart. Even since I put it up, we're a little bit lower than that shows. But it's you could see you had this bit of a triple bottom around 93.30. And we broke that last week, and you had this bounce up, retest of that line, and I don't see why you can't go lower in Aussie dollar. I mean, the RBA definitely wants you to go lower. If risk trades start to roll over, the central bank could talk about cutting rates again. They'd certainly like to see the Aussie dollar down at 89.90 again.
92 looks like a magnet, doesn't it?
Yeah, try to pull it down to there, and that'll be a nice spot to see how strong the market is. If it goes right through 92, I mean, we're going to 89. If you start to see a bit of a fight there and more of a chop, maybe your downside might be limited to 91.90. But I think we're going back to 89 at this point. The U.S. dollar's picking up, and the carry trade, might be off. But the risk trade is the big X factor in Yellen.
Yeah, so I'm curious because you've been pretty positive cable for a long time, and you were talking about the decline that we've had, and the last 2 days there's been a little shift in tone. Euro was acting better than the pound, and the last 2 days that shifted in euro pound. I wonder what your take was on cable here. Is the top in, Adam, or is there still a chance for plus 170 again in pound dollar?
I think I'd like to see 170 just to sell it. Carney really wrong-footed the market there. A lot of late money piled in when he talked about hiking rates sooner. I mean, the data was better today, but overall the data hasn't been so great. I do think we bounce, probably not all the way to 170, though. It's going to be one of those trades again. I mean, into yesterday, I think you were down 13 out of the 14 days, or 12 out of 13. So, again, tough to sell on that kind of weakness. But it's time for a retracement phase, if not for the cable side, for the U.S. dollar side as well, if the dollar's strengthening. Yesterday you had a bit of pound strength, but really nothing compared to the weakness that we've had. I think the market speaks for itself. It was a good run in cable, and I think the market is really calling Carney's bluff here. They're not going to hike this year. They're not going to hike in January. The great cable story, and it was a great run, is probably and these things don't usually go straight up and then down. So probably a matter of some choppiness around 169, 168. And then when everyone gets bored of it, then it'll fall. Okay. Just too many eyeballs on it right now.
Okay, anything you want to wrap it with, partner?
Yeah, I mean, same quick story with the New Zealand dollar as well. I think that you've got a very good sell there again. Just a lot of these trades, I think we're on the right trend here. This is the big trend we're in. We just need to see some bounces and sell these. And if you can sell a little bit and eat a bounce, that's fine. Same sort of thing in euro dollar. We're just seeing about the 100-day about to cross over the 200-day. The big sell signal, was the 55 fell below the 200, right almost in the peaks in July and June there, and that was the last great sell signal. Again, we've fallen so much, and we just broke below that line, as I was saying on ISM. Had some weakness there as well, but a little bit on the oversold side, and I don't like selling it here. Okay. So again, we see this is the CFTC data. Let's wrap it up there. Very weak, or just people piling into euro weakness, and it's probably a little bit overdone in the near term. And so it would be great, but you struggle to see the reason for a real squeeze on the dollar. Yellen can be dovish again. The market can shake it off. So it could end up being one of these things where dollar strength just keeps going, and everyone misses the bounce. A lot like the yen trade.
A rally that never comes.
Yeah, it just that bounce to get in, and it was the same in cable. It was the same in dollar yen last year. And then this Fed question is really on inflation, and that's just why I wanted to end on that. I mean, ultimately, though, there's two reasons the Fed can hike. inflation, which I don't think is a problem, but financial risk is becoming a problem. Buybacks in the stock market, debt issuance, just a non-creative use of capital and investment, because it's so much easier just to buy back shares.
Yeah, I was reading the other day, Adam, that that corporations are the largest single stock buyer in the market right now, and all the financial engineering that goes into these stock buybacks could be unwound in a hurry.
Yeah, and I think the Fed really should do something about that. And the Fed worries about hiking rates, but just going to 1% is not, it's not such a headwind for the economy to have rates at 1%. And I think they can do that, and at the same time say, we're probably not going to get to 3%. A lot of the market is expecting in 2017 for the Fed to be at 3%. I don't think that's coming, and I don't think there's a good reason to do that in the inflation picture. So why not go to 1%, but flatten out the curve and say rates are going to stay low? Maybe peak at 2% if you want to stay a little bit hawkish or keep the market on guard. Then you can keep long-term rates low and keep some of the liquidity, cool that out a little bit, and maybe shake out the stock market and force CEOs to be a little bit more creative with what they're doing with their money and invest it.
Okay, well, great themes today, as usual, Adam, with the overall dollar bullishness continuing. Tough to chase the dollar up here, but should the dollar pull back and we get bounces in euro, Aussie, crude oil, to you in your mind, they're great shorting opportunities.
Yeah, it's a few actionable ideas there, and it's starting to be a good market again. We get quiet Mondays, but good 4 days a week trading.
That is a blessing. Some of the volatility is coming back to the markets when everyone thought it was going to be slower. Actually started to pick up a little bit. Thanks for picking us up today, Adam, with your clarity.
Thanks a lot, Dale. It's always such a pleasure.
Thank you, buddy. Good hunting. All
You
right,
too.
talk to you soon, Adam. Cheers.
Cheers.